Hi again, everyone. This is Ed the Finance Guy. Thanks for tuning in. I greatly appreciate it. I'm very excited today because I hit 1,000 subscribers. Very happy about that. I appreciate everyone tuning in, emailing me questions. Thanks again. I'm doing something I love doing. I love teaching people about different items, being educational. I really enjoy that. Thanks very much. So today we're going to speak about, is it time to refinance my mortgage? It's all you hear about now. Interest rates are dropping, the virus is around, so you see interest rates now under 3%. So if you have a mortgage on your house, you're looking to save some money, which everyone's trying to do, this is the best time to refinance your mortgage. I don't really expect the rates to go much lower. Generally, you have to be able to save at least 2% on your mortgage. So if your mortgage is 5 and you're gonna get 3, it's okay to refinance. If you're paying, let's say, 4 and you're going to refinance to 3.2, it doesn't pay. And the reason is you have to calculate what your closing costs will be. So now closing costs are going to be a loan application fee, loan underwriting fee, any kind of discount points. There's a lot of different charges. So if you're going to refinance, there is a HUD report that you get, which explains all the expenses that you're going to have to pay. So try to see what the expenses are going to be for the closing. And be careful dealing with the right mortgage company. Sometimes you're told one amount and the closing expenses are a little bit more. So now what you should do is, for example, you're refinancing a $200,000 mortgage. You're paying $2,000 a month, for argument's sake. Now you're going to save $100 a month when you refinance, but it's going to cost you $3,000 to refinance. So if the expense to refinance is $3,000, you're only saving $100 a month, it's going to take you 30 months to actually get your money back that you're paying up front. So you have to look at that factor because 30 months is almost 3 years, so you have to decide, am I gonna be in this house long enough? If you figure you're gonna be moving in 6 months, you're gonna be moving in a year, it doesn't pay to do it. Why pay $3,000 to save $100 a month for a year? It doesn't pay. So you have to kind of have an idea how long you wanna stay in the house. If you're gonna stay in the house for the next 30 years, yeah, do it. Refinance, why not? And that will definitely save you money when you refinance. Even after paying the closing costs, you're going to be there 30 years. It's a big savings. And mortgages are the #1 biggest expense in someone's life. So if you can somehow save money on that, would be fantastic. Now, years ago, I was involved with a program called the Biweekly Mortgage Program. And what that program did, it took your mortgage payment, let's say it was $2,000 a month, and it broke it down to $1,000 every 2 weeks. So if you were able to make $1,000 payment every 2 weeks, there's 52 weeks in a year. That means there's 26 biweekly payments. So if there's 26 biweekly payments, that's equivalent to 13 monthly payments. So you're gonna make 1 extra payment a year, which is gonna go directly into principal, which will drive down your interest over those years. You'll have paid your mortgage off 6, 7 years earlier. When you have a mortgage, you have principal, you have interest. So in the very beginning, the first 7 years of a 30-year mortgage, you pay very, very little into your principal, very little. But if you're able to pay extra principal with your payment, that money will go directly into your principal. And then when they figure out your monthly payment, interest will be less because the principal will be less. So you'll be paying more principal every month. So the key is to always prepay as much principal as possible. I have a lot of clients, they get a refund at the end of the year, $2,000, $3,000. They automatically put that money into the principal, and that ends up saving them money. Now, the other choice they could do with that couple thousand is they could put it in the bank and get 1%. Why put it in the bank and get 1% when you could knock off a portion of your interest from your mortgage payment, which might be 4%? So it's as if you're getting 4% on your money by paying off your principal. And when you do pay off that principal, if you do the biweekly program or you call the bank and say, listen, I want to make a payment every 2 weeks, or simply make 1 extra mortgage payment every year. So if your mortgage is normally $2,000 a month, at the end of the year, send them an extra $2,000 as a separate check and write on the check principal only. You will knock 6 to 7 years off your 30-year mortgage. It's very important. And then at the end of the year, you're going to get a statement from the bank saying all the deductions that they took. They took money out for real estate tax. They took money out for insurance. It's an escrow account balance they have to manage, right? when you see that statement, make sure you look at it carefully and that they took the $2,000 extra principal payment that you made off the principal. Because a few banks got in trouble years ago because they were taking that extra $2,000 and putting it towards interest, which is crazy. So they will find large amounts of money. The biggest banks in the United States are the ones that were involved. So you have to make sure they take that money and they put it directly towards your principal. You'll see all of a sudden at the end of the year, you'll see much more principal coming off than you did before. The first year of a $300,000 mortgage, maybe you're paying $1,000 in principal or $900 in principal. Try to pay as much principal as you can. If your payment's $2,300, just send in $2,500. Try to pay an extra $200, $300 every month. You knock 4, 5, 6 years off your mortgage. It's beautiful. You get your mortgage paid quicker. If you ever needed money, you could always refinance, take the money back. If some emergency happened, like a pandemic like this, you may want to refinance, take some money out. But the best idea in life is to try to prepay that mortgage. Now, some people will say, well, it's a write-off. Well, I can write it off. Most people are not able to use write-offs anymore. They're not able to itemize, as I mentioned in a previous video. The cap on itemizing has changed. So most people do better with the standard deduction than they do itemizing. So the fact that you're not getting that interest deduction is not going to be that big of a deal. Better to just pay off your mortgage quickly. This way you're living in your house and it's mortgage free. It's beautiful. It's great. So one day you retire, you have no mortgage. That Social Security check, the pension check you get is going to get a lot further when you all of a sudden have no mortgage payment. Well, I hope this helped some people that want to refinance. Perfect time to refinance. Again, I appreciate everyone listening. Be smart, wear that mask, be safe. This is Ed the Finance Guy. Tune in next time.